Good day, fellow value investors. And yes, we value investors think the market is as dumb as a rock. This was a great comment here by M, discussing how all of these stocks are overinflated that we discussed because Wall Street media claim that China is uninvestable and therefore anything related to China is uninvestable. However, if the easy number of the stock starts with US, then it has no relation with China, but these companies have a strong relation to China. On the other hand, Tesla, Nvidia, Apple, AMD all have business in China, but they are US stocks and there's supposedly no risk of China involved. This just shows how dumb the market is, completely clueless. And as Paulo says here, if the market were perfectly rational, no one would ever play. And yes, there would be no value investing. So we as value investors know the markets are irrational, and therefore we play a game counting on the irrationality of the market. And that's also what I do on my research platform, follow businesses that the markets might undervalue, overlook, and therefore there we gain our fundamental investing benefit. And I have been doing that for 22 years now. It works. And let's discuss this. We discussed Estee Lauder booming on China and then busting on China again, but the bust happened lower and lower. On the contrary, Apple is booming and just keeps on booming, and the P ratio is now 36, but as a value investor, I remember a time when I wrote this article when the P ratio was just 10. So that's also something that changes. Apple, China, is there China risk? Let's just look at the numbers, but before that, let me just compare Apple with CK Hutchison, a stock trading in Hong Kong, but that has nothing to do with China. But the P ratio is a little bit different. Not 35, it's 7. 20% of the Apple P ratio. How much of Apple is produced in China? 95%. That means there is China risk, but nobody cares. There is also 17% of Apple sales in China, slowing down, of course, but nobody cares because Apple is a US stock, declining there in China. And when speaking of China and the risk there, this is key. 17% of the global economy is China. And there was usually the saying that if America sneezes, the world catches a cold. If China sneezes now, the world gets pneumonia. So China is now a big part of the global economy. It was irrelevant 40 years ago when the US was key and Europe, but now things are changing. And all these companies have huge, more or less, but significant exposure directly or indirectly to China. You go to Chinese stock trading in Hong Kong, cheap, and this company has nothing to do with China. Let me show you. Ports across the world, retail, infrastructure, telecom in Europe, other investments. If I look at EBIT from mainland China, the key is Europe, 13 billion Hong Kong dollars. Less than a billion is from mainland China, 150 million from Hong Kong, Australia, Asia and others, highly growing environments, 8 billion, and China is this. 2% is mainland China, 1% is Hong Kong, and the rest is the rest of the world. But this is trading at a P ratio of 7 because just trading in China. Yes, the market doesn't look at fundamentals, and I agree it's as dumb as a rock. And there are more ways that the market shows its dumbness. Same stock, a totally different view over time. Apple had a P ratio of 10. Everything, the growth was for free in 2016. Now it is a P ratio of 46 based on AI growth of some promise. That's the market, completely different perspective on the same thing. And somewhere it weighs the risk, somewhere it doesn't. China, yes or not, nobody cares. And nobody cares about the fundamentals as drivers of investment returns. In the short term, the market is always a voting machine, and in the long term is a weighing machine, and we focus on the weight. However, we must always remember that the markets can remain irrational a lot longer than you and I can remain solvent. What do you do then as a value investor? What's the key difference here? Pause the video and check for the key difference when it comes to drivers of investment returns. Well, welcome back. The dividend yield is 6%. This is what keeps you solvent over time, not this. Anything can happen. Apple can triple going forward. It did greatly, but we are looking at now versus the future. We are looking at the price now versus the future, not what happened in the past. And we are looking at the rewards now for what price. So we'll keep on doing our thing over time, over the market cycles. Value investing is what always works. The market works when it goes up. When it doesn't, that's a different story that you haven't seen for a while, but it might be a movie we keep on watching for the next decade.